Hello and welcome to the Financial Future Guide. I'm your guy and I'm your guide. My name is Alex and today I'll be taking you through the Canadian economy breaking or slightly delayed news for December 9th, 2020. In these videos, I like to look at the Canadian economy on a macro level. Then I like to touch on some news that we've seen recently from stocks that sell on the Canadian exchanges. Today we'll be touching on things such as IPOs or initial public offerings, RioCan and Enbridge's dividend, and what's going on with the Canadian banks. Alright, let's get right to it. The Canadian economy added 62,000 jobs in November, and seen here in this article from my old mate Pete Evans, he has outlined that this is the slowest month of recovery since COVID-19 began. Despite this not being the most positive headline, the Canadian economy has already seen many jobs that were previously lost return, along with a variety of new ones. Obviously, with more people back at work, the unemployment rate has fallen from 8.9 to 8.5. This continues the downwards trend that we've seen since June, and we are now sitting only 3% higher than we were prior to the pandemic. To get a broad view of the Canadian stock market's performance, we look here at the S&P TSX Composite Index, which is known as the benchmark Canadian index, representing roughly 70% of total market capitalization on the Toronto Stock Exchange. This gives us a fairly good idea of what's going on in the overall market for Canada. Taking a look at the 1-year chart, we are actually up on the year over 4%, which given everything that's happened is actually quite surprising. And further to this, we are now only about 1.7% down from our February highs. And if we look at the graph of this index dating all the way back to October 2006, the February highs seen earlier this year are actually the all-time highs. So despite the global economy and the Canadian economy being in absolute chaos from this pandemic, we're down less than 2% from our all-time highs. Now, I know we don't like to look at it, so I won't touch on it for too long. I'm sure you're all sick of it. But since early September, we have been trending upwards for new coronavirus cases. And as of yesterday, 7th of December, Canada saw just under 8,000 new cases. Despite how alarming this news may seem to many, as we can see from the performance in the Canadian stock market, this continual rise of cases does not seem to be affecting investors' mindsets. Over the course of the month, the Canadian dollar continued to get stronger, and upon the news of the improved job situation here in Canada, actually ended up at its 2-year high of the Canadian to US exchange rate. Some of the big news and something that many investors are looking forward to are a couple of IPOs that are actually expected to list this week. The two I want to touch on and the most popular are Airbnb and DoorDash. Now, first off, I want to say I do think both of these are good companies, and I think any company that focuses on solving a problem or making things easier with less traction for people is always going to have success in the long run on the basis that they can hold out their competitors. But I want to bring your attention to one thing. IPOs can be very risky. To explain what I mean, I want to show a couple of recent IPOs. First up is one that we're all familiar with, Uber Technologies, which is the popular ride-sharing and food delivery company. Their IPO, also known as the first time this company was available to the public, was on the 9th of May 2019. Over the course of the first 2 months, the company rallied, but then saw a sharp sell-off. And looking at the last 2 years of Uber, they continued to trade below their IPO up until recently. So if you were an investor that purchased this company at the IPO, you would have had to wait over a year and a half just to make your money back. Along with this, almost all new companies do not pay a dividend. So really, investors either cut their losses or they held this company for over a year and a half just to break even. Another example I want to look at is Beyond Meat. Now, just like Uber, Beyond Meat IPO'd in May 2019, and in their first 2 months, they had this huge run-up. And if you were one of the unfortunate investors that bought into the hype despite the crazy valuations, you would be down over 40% from the company's all-time highs. Even to this day, over a year and a half later, the company has still not got anywhere near those all-time highs. In fact, their next previous high is still 17% lower than the high that the company's stock price saw just months after its initial public offering. Now, don't get me wrong, I'm not saying IPOs are the wrong thing to do. I just think that it's important to take a step back, have a look at some of the risks, and understand what you're getting into prior to buying a company on its IPO. Now, this was a big headline for many Canadian dividend investors. RioCan slashes distribution, also known as their dividend, by 33% amid challenging environment. RioCan REIT CEO and also the founder, Ed Sunshine, let investors know that they should stick that dividend where the sun don't shine. And as we can see in RioCan's share price, they did sell off slightly upon this news, but since then has regained some of those losses. My main problem with this comes from May 12th, 2020, when Ed Sunshine actually came out and told investors that they did not have to worry, RioCan would continue to pay their distributions. Now, honestly, this rubs me the wrong way a little bit because I feel like Mr. Full of Lies Sunshine actually doesn't have investors' best interests at heart. The man has been with the company for almost 28 years. He is the CEO, trustee, and also the founder. For his services, he's paid $6.17 million a year, yet his ownership in the company is only $7.4 million. Now, I couldn't find Mr. Sunshine's net worth, but to the best of my knowledge, $7.4 million is a very small part of it. I put a lot of emphasis on skin in the game, and I think it's very important for management and leadership teams to have the best interests in the company's long-term outlook. As many of you will know, SmartCentres is actually my favorite retail real estate investment trust available in Canada. I actually just recently posted a new video on them discussing why I think they're the best Canadian dividend stock for monthly dividends, so go ahead and check that out if you haven't already. And no, this wasn't just a random plug of me saying go check out this other video. I wanted to bring it up because Malrays actually asked me, after the dividend cut of RioCan, do you think they are next in line? They being SmartCentres. And in all honesty, I don't know. I don't have any inside information on the company despite being super tight and homies with Mitchell Goldhar. But what I do think is it is very possible. SmartCentres' payout ratio has been climbing up there recently. I believe it's just below 90% of their distributable cash flow. And with by far their biggest competitor choosing to cut their dividend for the time being, and seeing that the news did not spark much fear in investors, they may be able to follow suit, save a little bit of extra money, and not take as much heat because they weren't the first to do it. Overall, I don't think that anyone should really be selling these companies if they do decide to cut their dividend for the time being. At the end of the day, if management does believe that this is probably the best move for the company, then I think investors should be fairly okay with it. Heading over to some good news, pipeline company Enbridge raises quarterly dividend. Now Enbridge is one of my holdings, so this did put a cheeky smile on my face, and it's great to hear that they're raising the dividend from 81 cents per share to 83.5 cents per share. If we have a look at the percentage change, that's actually a 3.08% increase, which isn't anything crazy, but nonetheless, given the environment of the energy sector, as someone who's invested in the space, I am happy to see a dividend increase. Enbridge is a great dividend company, and I also actually recently did a video on this stock too. They have many long-term contracts, very valuable assets, and a fairly predictable cash flow. This makes them a great option for dividend investors. In other news, we also just passed 800 subscribers today. Thank you everybody for all your support. Honestly, without it, I'd have 0 subscribers. Here's a quick little notice that the government announced 400 home office expense income tax deduction, and this just means that Canadians will be able to deduct $400 under a simplified home office expense deduction on their 2020 income tax return. The government also says that more details regarding this will come out in the following weeks. And if you're someone who has worked from home all year like myself, that's another $400 right into my little piggy bank so I can buy up more of my favorite companies. Here is an interesting article. Not even the COVID-19 crisis can hold back Christmas shoppers with savings hoard to unload. Quite similar to the way that not even the COVID-19 crisis can hold you back from hitting that like button. Now we're taking a quick look at ZEB, which is the BMO Equal Weight Banks Index. This is just an ETF that holds all of the major Canadian banks. So if we take a look at the performance of this ETF, it can give us a fairly good idea of how the Canadian banking sector is performing. Since the huge sell-off in February, we have continued to see fairly gradual gains, but just in the last week, we are up huge, over 20%. So this would get you thinking maybe there's some good news happening with the banks, and you would be completely right. The overall banking sector is now down only about 4% from their February highs, which is a fairly strong recovery in a low interest environment. Interest rates are far lower than usual at the moment, and as we know, this is how banks usually make their money. Royal Bank posts slightly higher profit and lower loan loss provisions. Despite everything going on, their overall profits hits $3.25 billion, which is up from $3.21 billion 1 year ago. TD beats expectations with higher profit, lower loan losses, and their revenue totaled $11.84 billion, up from $10.34 billion in the same period a year earlier. BMO profit jumps 33% to $1.6 billion, as BMO reported a fourth quarter profit of nearly $1.6 billion, up from just under $1.2 billion in the previous year. Now, Scotiabank is lagging behind a little bit due to their global footprint and some countries still being hit fairly hard from the virus. Scotiabank reported fourth quarter profits of $1.9 billion, which is down from $2.3 billion in the same period a year earlier. Revenue totaled $7.5 billion, down from nearly $8 billion in its fourth quarter last year. The bank's CEO concluded with, "We expect 2021 will be a transition year towards a return to the full earning power of the bank." Some more news is Sobeys brings back bonus pay for staff working in lockdown regions, and as you may recall from previous videos, Sobeys competitor Loblaws was taking a little bit of heat for removing their bonus pay for their employees, but then raising dividends to their shareholders. This may be Sobeys' way of giving a little bit of a slap in the face to Loblaws, but either way, it's great to see a company like this giving back to their frontline workers. I'd just like to add that I think the way that Sobeys did it is much more feasible, as each week eligible employees will receive between $10 and $100 extra depending on how many hours they work and how long the government lockdowns last. This is a much more affordable and easy to track expense for the company than how Loblaws did it with the additional hourly wage. Speaking of Loblaws, some cool news here is they are going to use autonomous trucks to deliver groceries in the Toronto area. The test includes 5 vehicles operating up to 7 days a week. Loblaws has teamed up with Gatik, which is a technology company in Toronto, to test out the autonomous vehicles starting in January. Now that's all for today. Thanks for watching. Remember to like, comment, and subscribe to see videos similar to this one.